Let's jump right into this explainer. Today, we're taking the industrial manufacturer Rotork PLC and putting it through the ultimate multi-lens stock valuation gauntlet. As an investment analyst, it is incredibly easy to just glance at a single metric and jump to a conclusion. But today, we're being completely objective. We're taking the hard financial data from Rotork's 2025 and 2026 reports, and we're going to stress test this stock using the legendary philosophies of Warren Buffett, Peter Lynch, and Benjamin Graham, right before running our own modern discounted cash flow models. Let's get into it. Here is our roadmap. We'll kick things off with a quick company snapshot, view the stock through our three guru lenses, Buffett, Lynch, and Graham, then run our DCF valuations and wrap it all up with a final, definitive verdict. Section 1. Company Snapshot. Establishing our baseline. So what does Rotork actually do? In the simplest terms, they design and manufacture mission-critical, intelligent flow control solutions. We're talking about the heavy-duty industrial valves and actuators that literally keep vital global infrastructure from, grinding to a halt. Whether you're looking at water treatment facilities, power generation, chemical processing, or oil and gas, Rotork provides the critical automation hardware these massive sectors absolutely rely on day in and day out. The stock trades on the London Stock Exchange under the ticker ROR. At a current price of roughly 286 pence, or £2.86, it commands a pretty hefty market cap of £2.36 billion. And the business is definitely generating solid top-line figures. 2025 revenues hit £777.3 million. And what's really great is they're translating that into a very healthy £106.8 million in free cash flow. Now pause for a second because you really need to hear this next number. Rotork boasts a peer-leading return on capital employed of 38.4%. That is a massive, flashing indicator of quality. It proves they have an incredibly efficient, asset-light manufacturing model. Instead of bogging down in heavy, capital-intensive manufacturing, they focus on high-value assembly and testing. That kind of capital efficiency is going to be absolutely crucial as we apply our first analytical framework. Which brings us to Section 2, the Buffett lens, focusing on quality and moats. We all know Warren Buffett wants businesses that are virtually unassailable. He's looking for a deep economic moat, which Rotork definitely has, since their highly engineered products have massive switching costs for customers. He also demands consistent earnings, a high return on equity, debt levels that won't sink the ship, and strong owner earnings. And for owner earnings, we can comfortably use their robust free cash flow as a proxy here. And guess what? Rotork passes the Buffett quality test with flying colors. Their balance sheet is pristine. We're talking a virtually non-existent debt-to-equity ratio of just 0.08, plus a net cash position of £65.3 million, and that's even after funding acquisitions and share buybacks. Add in an excellent 19.76% return on equity, and Buffett would absolutely love the fundamental quality of this business. But would he actually pay the current price for it? We'll calculate his exact buy price in our final synthesis. Let's pivot to Section 3, the Peter Lynch lens, growth at a reasonable price. Lynch famously categorized companies to understand exactly how they're expected to behave. Rotork delivered organic, constant currency revenue growth of 3.7% in 2025, and it pays a growing dividend with a 2.8% yield. So it perfectly fits Lynch's classic stalwart profile. These are large, stable, rock-solid companies that offer great protection during recessions, but, they aren't going to double in size overnight. But here is where Rotork really stumbles in our gauntlet. Lynch wants a PEG ratio, that's price to earnings divided by growth, of 1.0 or less. That signifies you're getting growth at a reasonable price. Rotork? It sits way up at 3.17. That is far too expensive for single-digit growth. Plus, Lynch loved those hidden, under-the-radar gems. With institutional ownership sitting at a massive 92.65%, Wall Street and the city have already crashed this party. For Peter Lynch, this setup is a clear avoid or even a sell at these levels. All right, Section 4, the Graham lens, deep value and margin of safety. Benjamin Graham's defensive checklist is notoriously tough. He's basically the strictest bouncer in finance. Rotork easily clears his adequate size requirement with that £2.36 billion market cap. It also absolutely crushes the financial strength check. A current ratio of 2.50 means its short-term assets effortlessly cover its short-term liabilities. Earnings and dividends? Super stable. However, Graham insisted on a PR ratio below 15 and a price-to-book below 1.5. Rotork's P of 21.18 and price-to-book of 4.04 mean it fails his valuation test completely. It's just way too rich for his defensive tastes. So to find Graham's exact theoretical buy price, we use his legendary intrinsic value formula. The square root of 22.5 multiplied by earnings per share and book value per share. For Rotork, we plug in the trailing EPS of 14 pence, or 0.14 pounds, and a book value per share of 70 pence, or 0.70 pounds. And the formula spits out an intrinsic value of just £1 and 48 pence per share. Compare that to the current trading price of £2 and 86 pence, and the stock is trading at nearly 100% premium to Graham's value. Simply put, Benjamin Graham wouldn't even look at this stock unless it dropped by roughly half. That critical margin of safety is entirely absent here. Moving on to Section 5, the modern math. DCF valuation and alternative models. To build our base case discounted cash flow, we need to project out Rotork's free cash flow. We're assuming a 5% growth rate for the next 5 years, which aligns perfectly with management's mid-single-digit ambitions and historical averages. Then, we apply a standard 2% perpetual terminal growth rate proxy just to account for long-term inflation. Finally, we discount all those future cash flows back to today using the source-provided weighted average cost of capital, the WACC, which sits at 9.53%. Now, assumptions are rarely perfect, right? So let's map this onto a sensitivity matrix. At our base case intersection of a 9.53% discount rate and 2% terminal growth, our DCF model yields a fair value of approximately £2 and 20 pence per share. So even with some pretty optimistic assumptions, the intrinsic value really struggles to bridge the gap up to that current £2.86 trading price. But if we map out some alternative valuation models to get a broader view, things do look a bit different depending on your metric. For instance, an EV to EBITDA multiple of 12x, which is fairly standard for high-quality industrial peers, points to a fair value of £2 and 98 pence. That suggests it might be fairly valued right now. Meanwhile, the average analyst consensus optimistically targets £3.83 pence, but that's heavily baking in high expectations for their newer target segments, like data center cooling and water infrastructure. Which brings us to our final section, Section 6, Synthesis and our final investment verdict. The story of Rotork right now is really a tale of two distinct realities. On one hand, you are looking at a fundamentally brilliant industrial business, asset-light model, incredible returns on capital, a pristine balance sheet, and massive structural tailwinds in automation, water modernization, and data centers. But on the other hand, we have to reconcile that phenomenal business quality with a highly demanding stock price that leaves virtually no room for error. To really put this into perspective, let's look at the theoretical buy-trigger prices for our investing gurus, assuming they all demand their signature margin of safety. Benjamin Graham, applying a 30% margin of safety to his £1.48 intrinsic value, wouldn't buy until the stock hit £1 and 3 pence. Peter Lynch, wanting that PEG ratio of 1, would need the stock down around 84 pence. And Warren Buffett, who we know is willing to pay up for quality, would still want a 20% margin of safety on our £2.20 DCF value, meaning he might start buying at £1.76. Notice how none of these trigger prices are even remotely close to today's market reality of £2.86. So the key takeaway here is that the risk-to-reward ratio is currently skewed. Yes, Rotork boasts an impeccable balance sheet with $65 million in net cash and absolutely unmatched capital efficiency. But the risks are very real. The valuation is priced for perfection, and as their recent Q1 trading update actually highlighted, they're currently experiencing customer-driven project delays in their Middle East oil and gas segment. And when a stock is priced at a premium, even the slightest delay can cause the market to aggressively re-rate that multiple downward. Drawing all of our analysis together, our completely objective final verdict for Rotork is a hold. If you already own it, congratulations! You hold a wonderfully managed, cash-generative business. But for new capital, the math simply doesn't support a buy. Keep this one on your watch list and wait for market volatility to finally hand you the margin of safety you deserve. It leaves us with the ultimate investor's dilemma. In a market priced for absolute perfection, are you willing to pay a premium for quality today or risk missing out entirely while you wait for a discount that may never come?